Welcome to the 1delta podcast. Today we're joined by Mikko Ohtamaa, a true pioneer in the crypto space. As the former CTO of LocalBitcoins, Mikko helped make Bitcoin accessible to people worldwide. His contributions as an early developer in the blockchain ecosystem have been instrumental in shaping decentralized finance and open source blockchain infrastructure. As the founder of Trading Strategy, Mikko is pioneering algorithmic on-chain trading, pushing the boundaries of what's possible in decentralized finance. Mikko, we have known each other for many years by now, and I know you've been a very busy builder, market researcher, and I think also famously self-described as a shit poster. How did you get into crypto in the first place?
I did get into the crypto in 2013, but even before that, I remember it very well. I was in a Python conference in Bristol in UK. I think it was 2011 or 2012. I was a mobile app developer back in the day. I had my own software consulting company, like everybody had at Nokia times. And there was this guy that was telling me about Bitcoin. It was not very well known back in the day, but he promised me that if I'm going to build the first Bitcoin mobile wallet, he's going to pay me 10,000 USD in Bitcoin. And I didn't take the deal. So it was a mistake. Then after that, like 2013, okay, Bitcoin was already getting popular. It had a few crashes, and there was a new venture in Finland by some of the Python developers I knew. They had started LocalBitcoins. I think it started 2012, and 2013 I joined the team there. They needed really help because the Bitcoin was taking off, and they couldn't scale the website, and it had all kind of problems in the LocalBitcoins for the just keeping the wheels turning. So I joined the LocalBitcoins, was working there 2013 and 14. And back in the day, the crypto was really different what it is today. Today it's all about number go up and ETF. But back in the day, it was really against the Wall Street, like against the bankers, and Bitcoin was like a part of the Occupy Wall Street movement, and people were really like ideologically aligned with the thesis, which is missing today. So 2013 worked for one of the first Bitcoin exchanges in the world, and that's how I got here, and I have been here since then. So that's the story.
Oh, that's really early, and LocalBitcoins. I do remember LocalBitcoins. Obviously, it was I think probably the first place where you could actually like buy in sort of a systematic way Bitcoin, if I'm not mistaken. Yeah, so really some nostalgic project. What did you do after that? Because obviously, like the evolution of crypto led to like new services that would eventually overtake LocalBitcoin, especially also like then with the rise of better online platforms that allow you to directly buy with some fiat on-ramps, including also exchanges eventually to buy crypto. What do you go doing after your entry into the space?
Yeah, so LocalBitcoins was a peer-to-peer exchange, so it didn't scale that well, and as you said, it was early times. So there was really no model, no regulation, no idea where this all is going. After working for LocalBitcoins for a while, I left it. I also left Finland, so I went to US. There was fintech startups like normal old school debit and credit card business where I worked for a while, and then came back to Europe. And in the end, then 2016, I bought my first Ethereum 2015 from a crypto exchange that was called Crypti. That was a rug pull. It was run by a Floridan guy who later disappeared. And then in 2016, I got into Ethereum development. So I think it was the Solidity 0.2 or 0.3 doing smart contracts. And 2016 summer was one of the events when the Ethereum really started to took off. So the price of the ETH was like $10. And there was this first ever large scale DAO happening that was simply called the DAO. And it was a first of the large scale ICOs happening on Ethereum. So we had ICOs before. I think Augur was before, but they raised the money on using a Bitcoin, old-fashioned send Bitcoin to this address way. But the DAO was the first that was using smart contracts, and it had a kind of an idea that how the real DAO can operate, that you get the token and then you get the voting and you have proposals and all of that stuff going on. Unfortunately, 2016 summer was too early. So Solidity was even worse programming language that it is today. So it's possible. It didn't have really debuggers. It didn't have best practices and so on. And the DAO guys made a re-entrancy issue with their code. I think re-entrancy was not even like understood back in the day, but it was flagged before the DAO was launched. Nothing was done to fix it. And then this guy, I think he's now actually known who the guy likely was, just re-exploited the re-entrance into the DAO and took most of the DAO ETH for himself. That was back in the day. It was when the ETH price was $10. That was 70 million USD as ETH, and it was a really large sum of the active supply. It was like
I think it was around 11% or so.
Exactly. Yeah. Exactly. And that then led to the split of the Ethereum mainnet and Ethereum Classic. And that caused all the hate in Bitcoin Maxi community for ETH, because they were like, hey, you are changing the rules and this is not immutable and so on, and all the whining. The Ethereum price, of course, it crashed and so on. But this all leads to a fact like what happened next. So we had Augur, then we had DAO. So then next came as a third kind of Ethereum ICO, or a second ICO that was using a smart contract, was called First Blood. And I had a friend who worked with the First Blood. He was one of the co-founders back in the day. Of course, nobody wanted to repeat what happened with the DAO like a few months earlier. So they asked me, hey, Mikko, can you audit the smart contract? I don't think we even had the term audit back in the day. It was review or something like that. And then I was like, sure. I mean, it is job. And again, there was like none of the tools exist, like how to audit or what to look for. So I was basically just back in the day, I wrote the smart contract in Python, and then I tested it in Python, and I checked that all the numbers work and there's no overflows and underflows. Back in the day, the overflows and underflows were like a huge deal. And it was a few lines of code, and it worked. And the First Blood launched, they raised the money. They were planning to raise like 5 million in 2 minutes. So it was like really popular. We didn't expect that to happen, and it actually just went up, and I was like, woo! And we were super. Well, of course, all the websites and everything crashed, so it was like normal bigness passing die. When the ICO was over, I was just thinking like, okay, I can do this, so maybe I just like start a career as a Ethereum auditor and a developer.
Yeah, that was really early days. A lot of opportunities, and I also remember early 2017. I mean, it was so easy to raise any money. I remember very well a meeting with one of the legal partner that did the Ethereum ICO back in the days, and we presented the idea, and we were looking to raise around 30 million for a crypto banking project. And he said, that's absolutely no problem. And that was the sentiment at the time, and was really interesting times with a lot of, obviously also scams, but a lot of pioneering projects, including the DAO, which set a lot of precedents. So yeah, it's a really interesting journey. And go on to do next, because I think you mentioned also token market. Which was responsible for also some of quite prolific projects that came out of it.
So that led to I had an experience with the First Blood ICO, and the First Blood founding team went to do their project. I think it's still going on. What happened with the First Blood, that their plan was good. They had also good execution, but the underlying business, because they are in esports, is so difficult because game publishers has too much power. So they just kept hanging there, and it's still going on, but they can't grow. So that happened with them. But I was not part of the core team, so I was just like an auditor and developer. So I thought hey, I'm basically the only guy in the world who has run a successful ICO on the smart contracts. So let's start to do ICOs. And I started a company called Token Market with my co-founder. It was later incorporated here in Gibraltar, where I'm living nowadays. And the first real ICO we did from the start to end was I think it was called Edgeless, and it was a online poker casino that you can have a poker and casino games on chain where the house doesn't have an edge. That's why it's called edgeless. So it's like a provable fair. And that was the first one we run. It was one of the unlucky ones that were using this multi-sig contract that was written by Gavin Wood, who went later to establish Polkadot. But this contract had a bug, and these guys lost all of their money, and that was the end of the project. It was lessons learned. So if you count like how much ETH you will have lost because of the hack, I think I'll be one of the persons who come very high on that list, because it was very, very early and the value of the ETH was low. Any case, edgeless, then we did some good ones that are still alive. We did the Storage, we did Civic, we did Monaco, nowadays known as Crypto.com. We did a lot of smaller ones. Some of them are still alive, but most of them, they didn't survive the 2018, 2019 bear market.
And then after token market, what did you go on doing next?
So the token market, it fell apart 2019. So it lasted like 2-3 years. We had a good run. It had a normal crypto company problems why it failed. So it was not for technical reasons. I can do another podcast on this topic later. But 2020 started. I was out of the work, or I was like, okay, what to do next? And back in then the First Blood guys calls me again, and they see that hey, Mikko, like you don't have anything to do and come to work as a CTO of the First Blood. And I went back there and I did the 1 year there. So I learned everything about esports. We did crypto, like we did token rebranding and token swap and all of that stuff. But it was mostly like the core business was about esports. So a lot of learning about game publishing industry and so on. And to be honest, it was good because at that point, my tolerance with the crypto industry was quite low. So I needed some to change. And then I did that 1 year, 2020, 21. And at the start of the 2021, I started the trading strategy as not as a company, but I started to build the business and have been doing it since then.
What inspired you to start trading strategy? Because I think in our previous discussion, you mentioned that someone recommended you to do algo trading with Python. And yeah, that, as I understand, is now a core part of your technology.
I have a theory, and it's not my theory because this was told me by a person back in the day, 2014, when I had left LocalBitcoins. I met him in Sydney, Python meetup, and I was traveling in Australia, having my holiday there, and I met him there, and he told me that, Mikko, that final destination for all Python developers are to become algo traders, because that's what you end up being. After going through everything else, you become an algo trader, and then you start making money. And I was like, yeah. And well, he was making money, so he was not lying. But I was not interested in trading back in the day. So I was not, I had, of course, trade some Bitcoin, but it was not for the profit. It was more like a OTC. I buy, sell Bitcoin for cash or card or PayPal or whatever, but not as a day trader. So I discarded this idea. But he was right. So I had 10 years of everything else. I can say that I know Python now inside out. I'm probably one of the top 100 Python developers in the world easily. So only thing for me to do was to start to do the algo trading. But it was not a choice I wanted to really take, because I was already trading. I was doing day trading, and I was using all kind of crypto trading bot services. I think 3Commas is the most popular one. They trade on centralized exchanges like Binance, and they were so bad. Like, not bad as their marketing is really good, and there's like they have a whales there, but their security is bad. Like 3Commas, like a lot of their traders API keys were leaked, they were hacked. They really lie you. So they are like their profits or whatever models and so on they say that you can get there is all like fabricated. It's not real. So when you start to dig in deeper, if you have any knowledge, you don't need to have a lot of knowledge, but if you have any knowledge like how to backtest or what kind of profits to expect, you can see that these services, they are like if not outright scams, they are like borderline scams. And if you trade there, even if you are good, you are likely to lose some money, because you are basically like gambling against the house. That's the trading bot services, and you can't win that game long term. And my co-founder, he had the same experience. So he was trading, and he was telling me like he was checking the profits in 3 commas, and then he goes to his Binance accounts and checks the same profit, and the number is different. It's like much lower. And he was like, this doesn't make any sense. Like you can verify that the trade was not profitable, and it says it's profitable. And then it led to the fact that, okay, we were like thinking how we can do this better. And I told him that the only way to win this game or play honest game, you don't necessarily win, but at least it's honest game that you have a fair chance, is that we need to do DeFi. Because in DeFi, everything is transparent. You can verify it, even if there is often a crooked game, but at least it's visible and you can be prepared for it. Like you are not the mercy of some centralized exchange that is playing against you. And that's how we created TradingStrategy.ai. That's basically the first ever real sophisticated algo trading solution for DeFi.
It's an interesting point you're mentioning with the lack of honesty of the trading venues in crypto. And it touches upon one of the points also where we as 1delta have a very strong sort of belief that we need to bring crypto trading on chain, not only from a systemic risk perspective, but also because you're often trading against the house, and everyone who went ever to a casino knows that it's not really a winning proposition. Can you maybe elaborate a bit more in what ways the house is trading against you?
The most obvious one is that they see your orders, and not just orders, but in this case, they also see your algos. So they know what you are going to, what positions you are going to take. So basically, they can front run you. So they can basically take opposite positions before your own positions happen. That's one. And not even that, if they don't do it themselves, then these guys are selling your data. It's usually called payment for order flow. So if they are not selling the orders themselves, they are selling your data to somebody else that's going to trade against you. And these are like something that you can't prove really, or it's hard to prove. But if you know any people in exchanges, if you have a personal relationship, well, we don't need to even have that anymore, because we have a SPF from FTX, and now we know, like, because of the court case, we know how the FTX was crooked in a way that they had their own access and they were front running everybody else. So that's the most typical case of problems. And other one is not related to algo trading, but it's related to exchange themselves. So having a centralized crypto exchange that's not hacked, or they can repay you in the case of the hack, is rare. I think the only ones that are left from the early days that have never been hacked are Kraken and Coinbase. Bitstamp, Bitfinex, they all have been hacked. They had to recover. And now even like the good modern exchanges that are regulated, so they should have their papers and security in order. By the way, FTX was regulated as well. Didn't help at all. So FTX, there was a Japanese exchange called Liquid, and now there was WazirX in India that just lost like 200 million a few weeks ago. Even if they used special crypto custodian that was supposed to protect against this kind of scenario. So when you go to centralized exchange, you can be never sure that they are not going to lose your money. It's not the case in DeFi, because in DeFi, if you are going to lose money, at least it's because of your own mistakes, not the mistakes of some other people who you can't verify or trust at all.
Yeah, those are definitely interesting points. Also, I think we had recently the vulnerability exploited by Certic on Kraken, if I'm not mistaken. And so you mentioned basically two exchanges have never been hacked. I think also, at least from what the public knows. So potentially also Coinbase had vulnerabilities that were never disclosed.
Any case, even the case of the Kraken and Coinbase, probably they have, but they can recover. So they can do a fully recover, because the damage that you can do or have been able to do is so small that they can pay it from their own equity, as we call in fund industry.
So your blog describes trading strategy as the first algorithmic trading protocol for decentralized finance. We popularize professional quant finance for everyday users, retail traders, CFOs, and small and medium-sized funds and trading firms by focusing on advanced and speculative trading strategies and risk-adjusted return. Can you explain this in more simple words what that means, and who is going to be the customer or the user of trading strategy?
It's a good question. And at the moment, it's probably going to change in the future, but at the moment, we are targeting users who are already trading crypto. They have the idea how to trade or why to trade. Usually, it's like common reasons include that you can make profit because markets are inefficient, and that's what it is basically. And our thesis is that with algorithm trading, your algorithm doesn't need to be very complex. It can be a simple one. It can be a rule-based. You don't need to use machine learning or any of the other fancy stuff. And you can still, you can easily outperform everyday trader, and you can still outperform. It gets a little bit more difficult if you don't use leverage, but you can still outperform like Bitcoin and ETH. You can outperform Bitcoin long term even by trading a Bitcoin because you are basically buy the dip and sell when it's hot. And it means that if you are here to just to get rich, so to speak, which most of the people are, they just speculate. Trading is much more easier the way to do it than just buy and hold, because buy and hold is always losing to trading in the long term if you are systematic. So that's the important word. You need to be systematic. So if you are a manual trader or day trader, you need to be on computer 24/7, which is of course what most of the people can't do. And then to get around that, you start to do algo trader. So you don't need to be computer 24/7, but you need to have some kind of algorithm that is doing what is your intention, like taking the entries and exits based on what do you think the market is going to do.
Why do you lose with the buy and hold strategy fundamentally versus an active strategy?
It of course depends on the asset, but usually what happens is that the cryptocurrencies are, if we talk about cryptocurrencies especially, cryptocurrencies are very, very heavily what's called momentum driven or trend following. So they have like a clear bull and bear markets. So basically your plan is to ride the wave, ride the wave so that you buy when everybody else is buying, and you sell when everybody else is selling, and you don't love your back, so to say, but you exit. You probably can't exit at the top, but you can exit like before or after the top, and then it goes down again. If you are doing spot market only, then you need to wait with your cash pile until the next bull market starts, and then you enter to the game again. And that kind of simple strategy is the cycle. The cycle might be like it can be a whole market, it can be like year cycle, but you often have like smaller cycles. You have a monthly cycle, weekly cycle, or day cycle, intraday cycle. So you can ride a lot of smaller waves instead of trying to ride the big wave, and that way you can make more money.
And this behavior of the market, is that specific to crypto?
Not really. Like we have the same at the stock markets, especially nowadays when we have these meme stocks, and we saw it when the COVID happened. So we had these stocks going up like crazy. We had a Peloton, and we had a Zoom and others that went up like crazy. But at the stock markets, it's easier to value these stocks because you can check like future cash flows and price to earning and so on. And those stocks were way too overvalued. So at the stock markets, it's easier to value. So you can see what stock is overvalued, but you can still like buy and ride the momentum and try to exit the peak, like you could have done now with the Tesla or Nvidia or whatever is going on right now. But in crypto, it's even more like that, because in crypto, there is no clear valuation model. It's all speculative, because everybody who is speculating this believes that it's going to be long term, it's going to be even more valuable. You don't need to believe if that's going to be true or not. But if you know that the other people believe it, you can still trade with them. And you trade with this kind of it's not mass hysteria, but it's basically the market sentiment that okay, now it goes up, and we all dream that the Bitcoin goes to moon, it goes to 100K. It's likely going to happen if the interest rates go down, and then it's just like a matter of when and how fast the price formation happens.
Do you think that will ever change sort of this behavior? Because I mean, fundamentally, I mean, like if there's more like demand and supply, then usually the price goes up. And I think one of the issues also in crypto is sort of the fundamental analysis is it's really hard to do, as there's no like discounted or sort of future cash flow that can be taken into account in most of the protocols, not all. And do you think that this dynamic will ever change in the case of Bitcoin, where we will stop sort of having one part of like the smart holders that know that they need to sort of hodl when the price goes up or the market moves up, and then offload some of the Bitcoin at near the top, and then try to rebuy some of those in the bear market, while the others sort of get more sucked into this wave and lose basically money on the way? Do you think they will ever change?
No, I mean, it happens in stock markets as well, and you can have these. Even the professional hedge funds, they are underperforming market sometimes. So average hedge funds beat the market, but as an investor, you still lose because their fees are so high, which is a second point about trading strategy.ai. But we can go back to that later. It is just like that's how the capitalism works, because you can't have efficient capital allocation unless somebody is losing. Because if you put money on something that's overvalued, you are supposed to lose money, and the people who are putting money on smarter things are supposed to gain money. So unless we have that, it's going to be like Soviet Union, that doesn't matter what you do, you are making money, and it can't work.
Well, if Kamala Harris is going to win the presidency, then maybe we're going to enter in such a future of equity, but I hope that's not going to happen. Yeah, let's go back to more the trading strategy part. So to make it really understandable what trading strategy is, what it offers. So basically we can run these algorithms, but how does the whole journey look like? From who is the person who can use trading strategy, and what is the whole cycle of like from the idea having a strategy to like eventually deploying funds and making a return?
So first of all, we have two kinds of users. So we have strategy developers, which we usually call quants. Doesn't mean that they are in quant finance, but it's easy to call them quants. And then we have an everyday user. So if you are a user, you don't create your own strategy, because that's a tedious job, and you can do it if you are really into stuff. But most people, they don't want. They just want to use something that's existing, like a product that they can earn money. And if you can tell them that these are the features or risk numbers or risk rewards you can get with this strategy, they are fine. Like it says that you can go up 200%, but you can come down 30% average on year. Okay, fine. Just put money in. And then we have the developers who keep creating these. But we can focus on the normal users who just want to earn money or speculate, so to speak. So these guys, they need to, as I said, it's a DeFi-based protocol. They need to show up at our website. They need to have their MetaMask or Rappi wallet. I recommend Rappi wallet for most of the users nowadays. They go there. They can browse strategies. At the moment, those strategies are on different chains. So we have Ethereum, Arbitrum, Polygon, because Ethereum ecosystem is what it is. You're probably going to need to have the USDC on a specific chain to invest in specific strategies. So that's one criteria. But there are like different strategies that are trading different pairs, and some of them are more aggressive, and we are going to have even more aggressive strategy in the future that try to go up faster, adding a risk that you also might lose more money. And then you go there, you browse them, and you pick and you click deposit, and then you deposit USDC from your wallet to a smart contract vault. And this is the key thing, because we are using vaults like all the yield farming protocols instead of centralized exchange accounts for this trading. And it means that when you are interacting with the smart contract from your wallet, we are no longer part of that process as a company. So even if the whole trading strategy the AI team disappears, you are always able to get your money back from that strategy, even if the trade execution stops otherwise. And getting the money to the vault is the step one. And then what we as a protocol do for quants and these strategy users is that our protocol runs the trade execution. And for that, we have our own oracle. So our oracle, what it does, that it reads the raw blockchain data. So it just goes to the nodes directly using JSON RPC, gets in events, gets in data, and creates market data feeds from these raw events. So it's the same, the price candles you see on every price website for crypto. But we do it without going through any centralized service. So we go directly to the chain, get the events, create the candles, and get the price. But unlike in the case of other oracles like Chainlink or Byte, we don't yet post this price back to the on-chain. We, instead of this price, data goes to our second stage in our oracle that we call the strategy execution. So these strategy developers, they have written their strategies in Python, not Solidity. That's too complex for this kind of task. So they have written in Python that's high level, easy to read, easy to audit. And the oracle also runs the algorithm decision cycle inside the oracle itself. So it puts the price data in, runs the Python code, which creates the trade execution instructions. So it basically says that after the Python code has been run, it says that, for example, buy Bitcoin, sell it. And then the oracle sends these instructions to the on-chain. So it goes to the vault with the instructions like these are how we are going to rebalance our positions today. And it will execute those orders on behalf of all the vault depositors, so to speak. And that's the cycle.
So the Python code, where does the Python code exactly run?
Yeah, it runs on the Oracle itself. So at the moment, our Oracle network is not yet decentralized. At the moment, the model is that we have one Oracle per strategy. So basically, it's in the parameters of the Oracle itself. And it's basically a hard-coded when you start the Oracle. For open strategies, you can browse on our website. You can even go through our website. You can go to click the strategies. And there's two sections that are interesting. One is the strategy source code, where you can actually read the actual Python code, what the strategy is going to do. It's not going to do anything else that's said in that Python code. And the other one is the backtesting results, like how this code would have behaved for the, let's say, last 5 years if you would have been trading based on these instructions.
Okay, so basically the user deposits funds into an Enzyme vault, and then the vault basically interacts with an oracle, which basically is the brain running the Python code or the algorithms for the trading strategy, and then puts this into certain actions like buying or selling certain assets are inside the vault. Is that correct?
That's exactly correct.
What are the possible ways also where there are potential flaws in this? I mean, as I understand, you still need to trust that. So you don't need to necessarily trust the Enzyme vault, because this, is a smart contract and has been audited many times. But the oracle and the strategies inside still are somewhat of a black box. How can you mitigate sort of that this part is sort of not getting exploited?
That's a good question. And the future answer is that we are just going to have more oracles. So it's the same as in every blockchain, that you have more validators, and you assume that at least part of the validators is honest. Depending on your consensus mechanism, it might be 60% or 50% or whatever, but at least part of it has to be honest, because if you don't have any honest actor, then there's little you can do. But in our case, especially now when we are running in a single oracle mode, we are still checking the trade instructions on chain. So we have a validator smart contract that checks in the instructions before we give them to Enzyme. And we have some safety checks there. Most important one we are using today is that we have a whitelist of trading pairs and the dexes it can use. And it means that for most secure algos, it will only trade high liquid pairs on Uniswap version 3 and nothing else. So it can buy Bitcoin, wrap Bitcoin, and it can buy it using stablecoin, and it can't do anything else. And for this kind of strategy, if the oracle is hacked, the worst thing that these guys can do is that they can create trades, and they can create bad trades. So trades that you start to lose money. And of course, that can have a problem. Like if you are malicious, you can make them to lose money. But it's not that kind of bad problem that you could disappear with the money right away. And Enzyme itself has a way to, there's a role called asset manager, not the vault owner, but the asset manager. So the asset manager is like an oracle in our case. Usually it's a human that actually is called, the human role is called asset manager, but in our case it's oracle. So in that case, if the asset manager goes rogue, we have vault ownership, now it's a proto DAO. So it's like a pre-DAO multisig, but later it will be the DAO itself. So the vault owner can kick out that asset manager, say that, okay, this guy is now going nuts. We don't want these trades anymore. And they can stop doing the trades. And that's like the final stop, that how we kick out these kind of bad actors from the system.
So it's actually a bit like as a circuit breaker if something goes wrong.
Yeah. And until you have like a sufficient decentralization, like there's a lot of things to go wrong, and it's better to have like multiple layers or breaks or circuit breakers where you can touch. And even it doesn't need to be like a adversary party. Like something can go wrong by the accident. Like for example, Enzyme Vault, it has slippage controls. So if you try to trade something that has too much price impact, the enzyme itself will stop it. And enzyme itself has a asset whitelist. Like only some assets are whitelisted on enzyme protocol and stuff that. So there's like multiple safety features that you can use to limit the damage when something goes wrong.
What other measures do you take to minimize sort of the risk of things going bad? I mean, obviously the market can sort of work against you and your strategy might not be sound, but I assume the code can also lead to unexpected behavior, or even just like someone just like coding a really bad strategy. So how do you as a user then assess and mitigate the risk that you're basically jumping on a strategy and put your money in where basically you also have a likely chance to not lose them?
Yeah. So I think that here comes the argument we discussed earlier about trading bot services. So for these kind of platforms like 3Commas or Trade Santa, what the strategy developers do is that you can cherry pick the results. So you can choose a time period or something else when you are showing the results that it performed very well on this particular time period, like it made 5x. But if you run it some other time period, it's going to actually lose 90%. So we have a transparent backtests. So we are publishing the market data, and we are also publishing the source code. If you don't trust the backtest results we are showing on our website, you can always take the source code yourself and run it, and it should give the same results. And that's like the ultimate stop there as a transparency mechanism. And we don't expect that the people are going to do that. Like it's even for average software developer, setting up a Python environment is a bit in pain. But we assume at least some people will do it, and we can have like delegations that they verify that okay, this runs correctly. And at the moment, we don't let anybody to just publish their own strategy without any vetting. So I think it will be a role for the trading strategy DAO in the future. Like we have Aave DAO and other compound DAOs that have these kind of risk commissions, or how they call risk teams, that will evaluate the strategies, and they only let the ones that have certain risk parameters to go live.
Yeah, I mean, crypto is anyways the best example for high risk, high reward. Although this podcast is not financial advice, do you have any insights in terms of like what returns you've seen with certain strategies that you have used during your testing over the last year or so?
I would say like it's still going to be volatile. I can first tell what we are doing at the moment, and then I can tell you what's the best in the world. So I have a good numbers for you. I picked them up this morning. So at the moment, our basic strategies that are based on the technical indicators, they don't have sophisticated models. So they are doing something, they are doing a profit like between 20 to 70% per year, but they have also a drawdown that's something like 20 to 30%. So every year, depending on the market, of course, and the market is changing. So you past is never a guarantee of the future. You can either make between 30 to 70% or lose 30%. And how you measure this is called, there's a standard financial metrics, how you measure your risk reward ratio. And the most well known is called a Sharpe number. So it's basically your profits divided by your risk. And Sharpe numbers we are seeing is somewhere between 1 to 1.5, maybe a 2 if you are lucky. So that's okay. And let me actually pull the information because we have it here on the website.
Can you also explain how the scale looks like and what these numbers mean for those who are not?
For that, I have a benchmark here. So here I'm having different SARP numbers. So here's an example strategy that gives a SARP of 1.7 in backtesting. It's likely to be lower in the future because crypto markets are getting more mature. So then we have a benchmark. So SP 500, which is the US stock market. And for the last 20 years, their SARP ratio has been 0.7. And then for the same period as we did for the strategy, I think it's the last 5 years, holding Bitcoin would give you a SARP ratio of 1.2, and it's the same for ETH. So you get a SARP ratio 1.2. And the difference between the Bitcoin and ETH is that the annual return of holding ETH is 90%, but the drawdown is minus 80%. The annual return of holding Bitcoin is 70%, but also the drawdown is minus 70%. And for the strategy, how it makes money, how it can outperform is that the drawdown, how much it can go down in a year is minus 30%, which is half what the Bitcoin and ETH have been going down in the past. Hope that helps.
And what does the scale exactly say? Like, is a lower number is better, the higher number?
Yeah, of course. Yeah, that was a basic question. So 0 means that you don't do anything. I think 1, it depends of the volatility of the market. And 1 is you are outperforming the stock market. 2 is already really good. It's like a super good. Most of the funds in the world, they can't reach 2. And beyond 2.5, you are like a godlike trader. The best ever SARP ratio or profits I have seen, I was checking one of the what is called a fund of the funds. So it's a crypto fund that's deploying their capital to other crypto funds. And this is a fund of the funds that it's picking every year. They are picking 10 best funds to deploy their capital out of 600 in the world. So they are like really picky, and their SARP ratio was 5. So it means that they are doing, I think it's a 30% yearly returns with only drawdown only like 4%. So it's basically a almost guaranteed way to give 1/3 more money every year.
Yeah, that sounds like the dream. Maybe we can still jump a little bit on the other side of the business, not just from the end user side, also for developers who want to develop a strategy and those who want to offer sort of their strategy for others to generate a return. Can you talk a little bit more about this and how someone can get started and what's really like the whole process end to end?
This is also interesting for how we compare against the other trading bot services if you are a strategy developer, because we can call it development workflow is local first. So anything you can run in Python code, we can also run in the live trade execution. So you are not limited to anything. So you can do whatever you can do with Python code, you can do in trading, which is different from these other websites that usually they give you just like a small text box where you can type instructions, and it's like not in a professional development environment, or even in the worst case they are like these kind of drag and drop tools, and you can only do a few actions that are allowed by the platform. So that's not us. So we are local first, and the tools you are using is the same tools you would use for normal software development, which is usually a Visual Studio Code for the most of the software developers today. And this, of course, means that the strategy development is geared towards more professional people who already know programming. We have few partners, if you can call them, like strategy creators that are partners who can't program. So they can't do Python programming, but they can still do strategies. So in that case, we actually handhold them. So we do the coding for them or show them how it's done. But most of the cases, these guys have been doing quant finance for some years. And in a quant finance, Python is the number one language. So they usually know it. But in the case you don't know it, we will help you to get there or port your code, whatever language you come from. And it's local first, so you can download the data locally. So we actually provide you like file downloads so that you don't need to use API for backtesting. And it's also super much faster because you are not using network. Everything runs on your local laptop. And tool you are using is called Jupyter Notebook. That's a generic data research environment for Python developers. It is also used in AI. So a lot of this kind of framework comes from what people are also using to train and develop their AI models. But we are just doing financial stuff instead of large language models here. And after your backtest is complete, like you usually create different variations if about it, and you create you test in different conditions and you tweak parameters, or you even use an AI to find the parameters for you. If it looks like, okay, it's going to survive. And in that case, you just copy paste your existing backtesting code to a Python module, and we can then deploy it as an Oracle. So as an input for the Oracle, we need two inputs. So we need to Enzyme Vault, and we need to a Python code that's attached to that vault, and then it can run.
And the strategy developers, I assume there also can be different use cases. So that's available for prop traders who just want to run their the strategies for their own funds, as well as for those who want to make their strategies available to third parties. And how does the third party part look like? How do you publish these strategies?
Prop traders, so they are the class of traders. For the audience, it's called the proprietary trader. It means that you are trading your own money. So it's all self-funded, and you are not taking anybody else's money there. And for prop traders, they can just trade it. We can have a different kind of. They don't usually want to disclose anything about their strategies, which is fine because they are prop traders. So that's their game. And to use our tools, they can just pay a monthly license like you would do with any software. But the more interesting category is the guys who don't have their own capital or own money. Let's say that you are a student. Your bank account is probably $500, so you can trade that, but it's not it's going to take a long time to make that number grow. So they want to have external trade capital for their strategy. And in a hedge fund business or quant hedge fund business, one way to do is that somebody is giving you a loan. So they are a specific investors that are specialized giving money to traders. It usually comes with the conditions that they take the profits first and they don't absorb any losses, and you need to put in some of your own money and so on, because those guys don't want to get screwed. So it's a debt-based funding. But usually what's very great in DeFi, and why I think the DeFi is the future of the finance, is that you can have what's called equity-based funding. So these vault users are taking the risk with you. So they are giving you actual money to trade, but it's not a loan, because they are sharing the strategy risk with you. And if the strategy makes losses, these guys make losses. But if strategy makes profit, these guys makes profit. It's the same as with any yield farm and so on. And because we have this self-custodial model from the vaults and yield farming, it's very safe as a counterparty that the strategy developers can't screw you over. And because it's risk-based and it's profit-sharing based, so the developer usually gets a cut between 7 to 15% and from the profits, and we get a cut as a protocol. We get a 5% from the profits. But if nobody is making money, there is no money to share. So if the strategy is making losses, it means that nobody is paying, and in the long term, if it doesn't make profit ever, it means that the people are going to withdraw their capital and put it on some other strategy.
How do you calculate the profit and loss? Is it based on the money that goes in and out of the vault, or is that also happening during certain time periods?
That happening at a certain time period. It's in a hedge fund language. It's called the crystallization. So what's your crystallization period? And we are using the formula that Enzyme is giving to us. So I don't know. I don't remember the contents of the formula by heart. But one thing I can tell in this podcast is that especially in this case of the current Enzyme version, and as far as I understand, all the vault protocols currently, what they are doing is that the profits are not marked by investor. So usually if you deposit to hedge fund, they are tracking your personal deposit and how much deposit this particular limited partner is making. But because we have a smart contracts and we really don't want to have what is called unbounded arrays. Let's say that we have 10,000 people suddenly coming to the strategy, and we would need to calculate the mark to market or mark to profit or net asset value for every investor on blockchain protocol level ourselves. All the EVM based blockchains would blow up, because the calculation cost is so heavy that you can't do it per depositor. And because it's you can create as many as depositors you want because addresses are free. It's also an attack vector. So that has led to the fact that these enzyme formulas to calculate the profit and the time period are distributed over all investors. And this means that your profit or losses doesn't depend only on what you are doing or when you are depositing, but it might also depend on what's going on with other investors in the world, which is not fair. It's we don't like it, but it's something that the EVM chain can do today. And we have discussed with Enzyme and other protocols that we really want this kind of investor level profit tracking, even if it's going to be costly. We want to do it, and if that's a problem, then we are just going to cap the number of investors. Let's say 400 investors per vault.
So you released version 1.0 this year, and you started out in 2021 and also got some VC funding back in the day. So it took you quite some time to develop version 1. What were the biggest challenges and learnings developing the first version of trading strategy, and what comes next?
Yeah, I think the problem we had as a company is that our minimum viable product or MVP was really large as a scope. And when we started, and still today, nobody really has done anything similar. So there was nothing to start with. So we had to build the market data feeds. Like if you want to have a decentralized market data feed, nobody's providing it yet. So we first year almost went to the fact that we get the data out from the Ethereum JSON RPC API to the format we want. And then the second part we didn't really expect was that, okay, now we have the data, so we can start to backtest the different trading strategies. And the good news is that there are plenty of different backtesting frameworks and tools and so on. But we actually found out that they don't really work for DEX data, because even it's just like a normal price action, but when it goes to the trade execution, you have swaps. You don't have a market and limit orders or order book and all of that stuff. There was still a lot of calculation to be done doesn't apply to centralized markets. But now we have we took a year to create this trade executor where most of the, let's call it value add of our software today lives. And we have a team of really, really good Python developers. So these are not noobs. They have been doing crypto projects before, and even from them it took a while. And I hope it would have been done faster, but it's just the scope was a bit too much. Well, it's now done, so you can cry later, but it's done now. Doesn't matter. It took a long time, and that's why I'm quite sure that if somebody wants to clone us, it's not going to be like cloning a Uniswap. You can't just go and copy paste those contracts, because it comes with infrastructure and different parts and very, very long list of unit tests and stuff like that. I think we have something 4,000 test cases for our code. So it's a huge amount to make sure that all the parts work together. And the trick is that to make all the parts to work together is the hardest part.
In your article describing version 1, you also mentioned the lack of shorting as one of the main challenges. And we already started our discussions for the integration of the 1delta protocol last year, and are still working on it. Can you maybe elaborate a little bit on this very problem and what our integration looks like and what problems it solves?
So the first demand from our strategy developers is that they want to go both long and short, because long only strategies, or we can call them spot market strategies, they don't make money unless the crypto goes up. And in that case, you can just, as we discussed earlier, you can sit on your cash. And in our case, that's not that bad, because we are in DeFi, so we can put our extra cash into Aave or even some yield farming protocol. So it's not idle really. You can get something between 4 to 7% interest on your idle USDC. But what really the strategy developers want, they want to go both long, and when the crypto market turns around, they want to short crap out of it to the bottom. And when we started, there's 2 ways to short, or not even short, but to take what is called a leverage position. Most common way to do it in crypto is called perpetual futures, or perps. That was pioneered by Arthur from BitMEX back in the day. And it means that you have a constant funding rate. So you are constantly paying a small interest on your position for the loan, what you are taking. And in the perp markets, shorts are paying longs and longs are paying shorts. So basically you are betting against the other side of the market all the time. And that's how the funding rate is formulated. Perps are a most common way to shorting and leveraging crypto, but they have a few disadvantages. First of all, they are really, really expensive because the funding rate is high. So even if you are correct on your trade, if you would have sorted FTX FTT token when it crashed, your trade would have been profitable. Like you sell high when it starts to crash and you buy it back when it's low, but you would still lost money because the interest for building your short position was so high. So as an alternative for perpetual futures, what we can do in DeFi, I don't think you can do it on centralized exchanges. We can do to build short positions, we can do the old-fashioned lending markets. And in our case, it's lending pool, it's Aave, Compound, and so on. And in those markets, people are lending out their tokens. It's either USDC, Wrap Bitcoin, or ETH. And as a trader, you are borrowing those tokens for lending pool users or other Aave users. And if you, for example, want to short ETH, you go to Aave, you deposit USDC as a collateral, then you borrow out ETH from the Aave users, you go to Uniswap and you sell it. So now what you have is debt in Aave and you don't have any ETH left. You wait that the market goes down, the price of ETH keeps crashing. And when it has crashed enough, you go back to the Uniswap. You have the extra cash you got from selling your ETH that was borrowed. You buy back the ETH from the market, and then you go to Aave and you repay your loan with the ETH you just bought back. And that's also how the shorting works on the old-fashioned traditional finance equity markets. So basically, you need to find a stocks to borrow that you can short them. And the benefit of this model using Aave is that its interest rates are really, really much better. Like, for example, I think shorting Bitcoin, the interest rate in Aave is like 1% yearly. But if you go to centralized exchanges and perps, it can be 20 or 30% yearly. So the difference is massive. It of course matters more if you have a higher size for your position or longer period. So for short positions, it doesn't matter, but the DeFi is really, really more cost efficient way to do it. And the trick is here why we are using 1delta is that building these Aave positions, like getting the position to the leverage level you want, you can do looping or you can do flash loans. And it's not like Aave doesn't actually give you a button or even the smart contract for yourself to do it. So 1delta is providing this aggregation service that they build your position for you. And we don't want to deal with that kind of complicated smart contract logic. So that's why we are using 1delta to build our leverage positions.
Yeah, and we're super grateful for the collaboration with Trading Strategy. It's been our first use case when we last year that we explored on the integration side. And I think there's still a lot of work to do, but yeah, I think it's something we want to do more in the future, exploring how others can use our protocol as well to deliver value and make DeFi more accessible. Because I think it's part of the evolution of DeFi, starting with the very base primitives like swaps and lending, and then building out the stack and making it more accessible. And it's great to basically see how we can add sort of to the stack of DeFi. On the DeFi side, I mean, you are kind of pioneering the algorithmic trading on DeFi. And what's your general sort of view on where DeFi is standing? I mean, there's a reason why you are one of the first doing this, and you're not going to be the last, but that also means as pioneer, you're usually entering in the very, very early stage of the evolution of a market or industry or technology. Well, what's your take on the current state of DeFi, and how long will it take to get us to a place where this will be the dominant way of trading in crypto?
It's a good question, and at the moment we are sitting somewhere between. I think it's like DEX to SEX or centralized exchange market volume is the ratio is that the DEXs are between 10 to 20% of the overall volume. So DeFi is, let's say, 1/5 of crypto trading. And good news is that this number is going up. So centralized exchanges are losing at the moment. And I think there are multiple reasons for it. My favorite one is that if you have a self-custodial model, it's more secure, as we discussed earlier. That it's if you have a token that's sitting in your cold wallet, it's not going to disappear from there. Nobody can hack. Well, they can hack it, but it's like takes a lot of effort. When as in centralized exchanges, they can be hacked, but they can be also bankrupt, or they can be closed down a regulator. So there's this risk. So it's a safer, and especially after the FTX happened, a lot of traders started to value this because they lost a lot of money in FTX, me including. So they understand the benefit of DeFi. That hey, we have burnt our fingers once, so how we can avoid doing it again. And I'm sure that we haven't seen the last centralized exchange hack or a bankruptcy or whatever yet. So they will be coming in the future, and people are going to lose again hundreds of millions, even if not billions in these cases, but not in DeFi. DeFi, you have other problems, but the counterparty risk is not one of them. Then we have also the accessibility. So for our product, for trading strategy to AI, as I told, there are existing centralized exchange competitors, trading bot platforms that trade on centralized exchanges, but those are damn hard to use. Like you need to deal with Binance API keys. You need to create certain kind of keys. You need to whitelist the key. You need to do all kind of integrations and very technical stuff that's outside what the normal users can do. So even those trading bot services, even if they have been getting simpler, as long as you are integrating with a third-party exchange, there's like a lower limit how simple you can make it. And DeFi can it take much further, because as we discussed, all you need is your crypto wallet, you need your USDC, and our website has literally for users, we have only two buttons you need to be able to press. One is called deposit and other is called redeem. So it's basically a two-button service. Whereas in trading bot platforms, you need to press at least. I actually mapped it out for one of the trading platforms, how many steps you need to have to get it up and running, and it was like between 15 to 30 steps. So DeFi is actually simpler for this kind of value-adding services, especially in the finance industry. And the third reason is regulation. So, for example, it's a good thing that the regulation is coming, but it's also making life for the everyday users more difficult. For example, there might be a disagreement between the users, what they want, and what does the regulator want. And a good example of this is that Binance blocked USDT or Tether for European Union users. So they basically you can't buy USDT anymore in Binance, or you can only reduce the amount, but you can't trade with USDT on Binance, and that's a bad news for a user, because that's where the liquidity is. So that's where the most depth of the market is, and you are forced to use crappy exchanges or crappy pairs where you are going to get a worse price as a European Union citizen. But that's what the regulators want. So that's there. And it's going to get only harder, especially if you do this kind of stuff that's now like maybe not mentioned United States, because in the United States, everything is illegal security. It doesn't matter what you do, it's going to be illegal. But in places like European Union, India, Middle East, they are squeezing crypto. They are not squeezing crypto too hard, because even for the states or nations, there's more to win than lose. So you don't want to squeeze too hard, but you squeeze like a little bit, especially getting these scammy crypto exchanges out from the markets. And it means that those people who are left without options, the only options where they can do this kind of trading is left is DeFi. We know that you can't close Uniswap. Of course, you can go to block the front end and so on, but it's so difficult. It's so difficult to close down that we will enjoy it for a long time, so to speak. Regulators will try to adapt it, and I think the concern of anti-money laundering and KYCs on DEXs, they are valid concerns. I think there are already some chains like a Kinto, where it's basically a KYC chain that everybody on a chain is KYC'd. I'm 100% sure that the Base from Coinbase, the new layer 2, is going to be a KYC chain in the future, but they will turn on the KYC after capturing all the market, because it doesn't make sense to start it from the scratch if you can avoid it, because everybody hates KYC. And we also know what kind of problems you are going to have with your passport and address and all over the place. Like, for example, my own passport, I have KYC'd in so many hacked crypto exchanges and debit card providers, and my passport is basically a public domain today. Like anybody can go to a darknet and download my passport because it has been in so many leaks. So that's the downside of the KYC, but it is coming because I don't think the regulators are going to allow it to run like without KYC forever.
Yeah, regulation is a double-edged sword. It can really protect market participants and make markets better, but it also can be abused. And I think this is what we've seen across jurisdictions in the world, that in the last decades, large institutions figured out how to capture regulators and make them basically their agents working for their benefits, and leaving the smaller businesses and the end user, the individuals behind. But in the evolution of DeFi, I also see like other challenges, especially also challenges we see at 1delta in our daily work, which is basically the fact that there's so much segregation in DeFi, because we have maybe about 100 networks that are somewhat of a size of relevance, and they all have their own small DeFi ecosystem, meaning there's a lot of segregation in how you can access assets and liquidity. How do you deal with all of that in trading strategy?
Yeah, at the moment we are not dealing with it, and I'm kind of Ethereum maxi myself, but I think the rollup centric scaling, where you create these L2 rollups, and that's how you scale the Ethereum mainnet, it was a mistake, because before we had a sharding, that would have been much less fragmented. But the rollup centric scaling is what we got, and that has led to the fragmentation of the liquidity. And it's going to be some years before it can be fixed. Now they are proposing all kind of chain abstraction solutions so that we create a first Ethereum mainnet, which we split to a different L2s, but then we create a third blockchain that actually going to take all of those blockchains we created before and create them again in a single blockchain. It doesn't make any sense. It's like creating solutions for the problems you could have avoided in the first place. It's just like this kind of academic impractical solutions, but it creates work for the people, and it creates more L2s where VCs can invest and lose their money. So I don't care. Like that's how it is. So and I can say that the simplest answer here is that just use Solana. The worst mistake we did as a company, that we didn't go to Solana. We went for the Ethereum ecosystem. It has been as a hindsight, we had been able to go to market much faster. We would have access to much better liquidity. We would have much more users. The user experience would be better if we had used Solana. But we chose Ethereum. So what can you do? Like, you need to live with your choices. You can't change them overnight. But the key thing is that the chain abstraction will come. I'm sure about it, and they have clever people working on it. But like the problems before, like proof of stake and account abstraction, like getting a proof of stake live, it was promised to be when it was 2016, it was promised that it's going to happen in 2017. It took like 6 more years. Account abstraction we have been talking about it for now like 5-6 years. It really doesn't work today at all. I mean, it works, but it doesn't really, it has not solved any of the problems that it promised. And I don't think it will ever solve. And the same for the chain abstraction, because it's a solution of the problem you created in the first place. And the problem is bigger than the original problems. I think the chain abstraction will come, but it will take something like 10 years or 5 years. And meanwhile, I hope that we have legit blockchain ecosystems that are not Ethereum. For today, we have a Solana. Solana was a joke like 2 years ago, but nobody's joking anymore. I hope we are going to have more. I hope Near is a good tech team. Now we have a Ton blockchain from Telegram. It's supposed to scale. It doesn't scale, but at least on a paper, they promise they are going to get there. So there are going to be other alternatives for Ethereum. And if Ethereum doesn't get their shit together in time, not fast enough, if they're going to spend 5 years on a chain abstraction, it just means that eventually most of the people will end up somewhere else.
Do you think you will someday embrace chain abstraction in a future version of trading strategy?
Yeah, we need to do it. We need to do it. But And it's already possible to do it in a way that these are these protocols, layer 0, Axelar, others that provide you what's called a request for quote pricing, RFQ pricing, where you just send an order and ask them to get me the best price, and they go across all the chains and try to find you the tokens. The problem is that it's just like at the moment it's just like too expensive, because they add their fees on the top of all the DEX fees. So it means that you are paying something like 0.5% or even 1% per trade, which is like the cost is massive. It doesn't make sense to trade that kind of prices. So getting the price down is of course the problem, but the problem is that these protocols, they want to take their own fee in the middleman. So they are basically adding a middleman in the process that the blockchain was supposed to eliminate in the first place. So it never can be cost efficient or it's going to be less cost efficient. Maybe it's good to trade there in some day, but the trade-off is that you just go to a chain directly yourself.
Some solutions are expensive, but I think there are also some alternatives that will emerge also around intents. I think there are different designs how these basically intents are solved or filled, and some just use existing on-chain sort of swap mechanisms like AMMs, and then are just a very complicated transaction that include a lot of fees, slippage, and then the solver fees on top. But then there are also alternatives where the pricing is done by professional market makers or the solvers, and giving you even better pricing, especially for larger transactions on AMM. So I think it's not something to completely write off as a non-solution, but it's overall still very early stage, and also given the need for some robustness for what you do, it might be a bit early to integrate.
Yeah, and it like you can find these solutions like a CowSwap and 1inch and others, but even today you have a Uniswap X. That's their own product. So, but the trade-off is that it's always comes with some degree of centralization, and it actually goes against the blockchain value promise. And I think the CowSwap is like the most decentralized ones of these kind of services, but there are like most of them are running on a single server, so to speak. And if that's what we need to do for the next 5 years, I'm happy to do it because there is nothing better, and we really have to do it. But it was not really like it's actually worse that it was like 2 years ago.
Maybe moving to one of my last questions. In our preparation, you said a very interesting thing, that machines will take over wealth management. What do you mean by that?
It's very simple. Trading is mostly it's math. Even investing is math. And now machines beat human in chess. They beat in Go. They beat in StarCraft. They beat in poker. So it's like making an assumption that the machines can't beat humans in trading and investing is like it's not realistic. They are already like hedge funds are using it. They have been using machine learning for the last 20 years, so it's nothing new. But it has not been exposed as we can do today with the DeFi and blockchain. And it means that, okay, we have a machine that's doing the trading. It can be a simple algo, or it can be a more advanced AI in the future. And you are just betting on that machine or algo or AI instead of putting your money in. You put your money directly on that particular, we can call it machine, instead of going to a fund where you have people working for you and they are taking the management fee. That's usually a 2% a year. Doesn't matter if you make profit. So it means that the machines that are better trading, if we can create an ecosystem where you are able to have the machines do your wealth management, and you can still have some of your own control, like what kind of strategies, what kind of markets, and so on. There's like knobs you can turn. But it's much more cost-efficient way to do the business than you go to speak to somebody who is in office with a suit. They can shake hands, and then you talk and have a coffee, and 3 hours later they will give you a paper you need to sign, and then you are paying like 1% commission for that guy because he was giving you a coffee. So you end up with the worst results that will cost you more, instead of just going to computers directly that can do it for you. So that's kind of an argument I'm looking after. And of course, it doesn't eliminate all humans. So there's always going to be humans in the loop. but the number of humans we need is going to be like reduced to a 1/10 or 100th of what we have at the current financial markets.
Yeah, it's an interesting thesis, and I do agree that I think there is a lot of value extraction that is unnecessary in the financial sector. I mean, it's, I think, in general, like a sector that is way too big for the economy, and it doesn't seem to be that the people working in the financial sector are really creating that much value compared to people who are engineers or doing the actual work in the economy in blue collar jobs. So yeah, I think it will be interesting to see how that will change, and I think also DeFi will be an important component to make this machine trading happen. Is there anything you would like to add before we are closing?
What we at tradingstrategy.ai, what we need at the moment is the traction and beta testers. So we are new protocol. Even if you don't believe that we are going to be successful as a protocol, I would appreciate that you do it for DeFi. So you come to a tradingstrategy.ai website, you pick any strategy and you put 10 USDC in. And if you find any bugs, just come to our Discord. We will fix you. If you are a nice person, you are likely to get the airdrop as a compensation for your efforts.
Thank you so much for being such a diligent builder over these many years and making so many important contributions to the field. You spent the last 3 years building, basically paving the path for the future of algo trading in DeFi. And I know from my personal experience being the first, it's really, really hard. Yeah. Thank you so much for doing what you do. And thank you for coming on to the show.
Thank you, Kevin. And also likewise, it was a pleasure. And I'm not a podcast person myself, but I'm really, really looking forward to listen to all the podcasts you are going to do.
Thank you so much.